Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. Greg Ebel joins us. He is the CEO of Enbridge Energy. It's a New York Stock Exchange listed company. The ticker is ENB. The company reported some earnings today. So, Greg, talk to us about, thanks so much for joining us here. Talk to us about kind of what you guys reported with your latest earnings results and kind of what's the outlook you're telling the street these days.
Yeah, for sure, Matt. Paul, great to be with you again. And yeah, a very solid quarter, both operationally and financially for us, right across all of our business. You know, we saw record volumes and results on the liquids business. Our mainline pipeline system saw record volumes. Our export facilities saw record volumes. And so we beat, obviously, the street estimates for the quarter, which is great, and reconfirmed that we would meet our goals for the full year. And we announced a little bit of tuck-in M&A. We bought some renewable offshore wind facilities that we had originally participated in Germany, and then renewable natural gas facilities in the United States. All very long-term contracts, 10 years or more, and all very consistent with that, all of the above approach that I think the public wanted, investors want, and that actually creates a lot of value for us. So we're pretty excited about the road ahead.
Why is, the stock's up today, but why is it down 13% year to date? Is it the underlying commodity that's a problem? Is it concern about demand? What's holding the stock down?
You know what? We have been, and very proudly so for decades, increased the dividend year after year, very utility-like in that structure. And as you guys pointed off just a few minutes ago, with interest rates that have been up, that impacts dividend-paying stocks like ourselves. And as you've seen in the last, call it 4 days, what we've seen 40, 50, 60 basis points coming in on the 10-year, you've seen the stocks that pay dividends react. So it's not the commodity. It's not energy demand. We see up those. We don't have commodity exposure. Really is that 10-year interest rate side of things. So that's a macro factor that, frankly, I can't do anything about. What we can do is make sure the company runs well, meets its earnings targets, and continues to build up both organic growth and some of these acquisitions.
Greg, talk to us about, again, you mentioned some of these acquisitions and the investments you make in renewables. Realistically, do you have a good handle on the types of returns you can get on renewables? It just feels like maybe some of the shine is off that side of the energy business.
Well, it's a good point. I think investors are starting to figure out that renewables are all not built the same, right? So those that have long-term contracts, in other words, 10, 15-year contracts with great counterparties, so larger utilities or big industrials, those are the ones you want to participate in because, they've got a guaranteed price set on that power. They've got a great investment-grade customer that's taking that power, and you're going to get paid. Those that are kind of going in a merchant world and haven't got these things contracted, or in jurisdictions where it's extremely difficult to build things, which is a lot of jurisdictions these days, I think you're seeing those entities being, a lot tougher to get the returns that the ones I previously talked about, which is why our renewable business, which we've actually been in for 20 years, is all about that contracted business. So our European stuff, our customers are folks like EDF, Electricité de France, or the government in Germany. And then here in the U.S., most of our customers would be utility-like players. And even on the renewable natural gas tuck-in that we had today, we have 10-year contracts with the likes of BP and Shell. So I think, and I think this is great for companies like Enbridge who have done it on a low-risk basis, that you're going to see differentiation. Those that have actually structured their businesses to create good returns, double-digit returns, are going to be rewarded, while those that have gone more merchanty, I think that's going to be a tough slug for them.
Where do you see demand going for energy? I mean, as we see the jobs numbers miss, and as we expect either a soft landing or a recession, I imagine demand slows down. Is that the case?
Yeah, typically energy is about 2/3 of GDP. In other words, energy growth grows about 2/3 of GDP. So if you thought GDP was going to be 3%, you get energy at 2. That's one. Two, remember, people don't shut off their lights and they don't turn off the gas in their house even when you're in a recession. Where you see it is on some of the industrial load, but most of our stuff is for ultimately residential players. So I don't see that has any big impact. But remember, we're building assets for 10, 20 years. So virtually every report that you would see globally and in the United States, we will be using more energy 10 years from now than we use today. And particularly so in developing countries, you're going to see them continue to move up the economic food chain, and that always requires more energy. So some of our assets on the export side of things, whether it's our liquefied natural gas export facilities we're building on the west coast of Canada, or our oil export facility on the Gulf Coast of the United States, which is the largest in the U.S., you continue to see very good response there, even through recession. So, yeah, I think the demand comes down a bit, but it continues to grow.
So I saw you announce intentions to buy some utilities, I guess in Ohio, North Carolina, and Utah. I mean, it's a big number, $14 billion. What's the strategy in the utility biz?
So it's interesting, maybe a little bit of contrarian, but I think we're right on this. We've been in the utility business for a long time. We've got the largest gas utility in Canada. This will make us the largest gas utility in North America by volume, serving some 7 million customers in jurisdictions that are really gas friendly. So they actually have ban legislation, if you will. They will not allow communities to ban natural gas. They know how important it is for industrial growth. Think of what's going on in Ohio, so much from a steel, automotive, refining perspective. Gas is critical. And then growth areas like North Carolina and Utah, very favorable environments. So we saw that, and it fits right into our dividend paying, low risk environment. And gas continues to grow. In fact, these utilities, you will see their rate base, or if you will, their customer setup and the assets that they use grow by a compound annual growth rate of 8% through the end of the decade. So that was our strategy. We had a seller that was largely an electric player that had to move out of that business for other reasons related to its electricity business. That created an opportunity. We were able to buy that as historic lows, 1.3 times that base of the business. So we're a big enough player we could buy all three, and that's really exciting for us as we move and close those in 2024 and have them fully in the barn and ready to produce in 2025.
So I'm looking on the Bloomberg terminal, Greg, and I see a dividend yield for you guys of 7.6%. I mean, that is just huge. What's the dividend policy you kind of communicate to your shareholders?
Sure. So we pay out, and we've been paying a dividend for forever, and it's an important part of our equation. I think our compound annual total shareholder return is about 11% since 2000, and you go back to the 60s and you'd find it about a similar number. And the philosophy there is, as we build these low risk projects and we bring them in, we can pay out 60 to 70% of that cash flow to investors through dividends. And so the higher yield right now is really driven by, as we talked about, the 10-year yield having an impact on that. People will put their money in U.S. Treasuries versus some dividend-paying stocks. So I would expect that to come down, the stock to go up as you see some softening on the yield side of things. But that 60 to 70% payout, very comfortable for us, very much in line with our cash flow, and allows us to retain enough cash to continue to invest in the business.
All right, Greg, thanks so much for taking some time. I know you guys are busy today with your earnings. Greg Ebel, he is the CEO of Enbridge Energy. ENB is the ticker. I'm looking over the last 5 years, compounded annual return of about 8.5%, better than its benchmark index. So some solid returns there. And the stock is up slightly here today.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Jay Hatfield joins us, one of those smart folks we like to chat with, CEO, founder, and portfolio manager at Infrastructure Capital Advisors. And Jay, this has been good week for risk assets here. I mean, we got yields pulling in 50 basis points on the 10-year. We got the stocks up 5 days in a row. What'd you make of the jobs print today? What are you making of this market right here that we've seen recently?
Thanks, Paul, Matt, for having me on again. We put out a note on Tuesday because things were looking a little bit bleak last week, I'd have to say, because you'd have great earnings reports and terrible price reaction in the market as a whole. But we did some work on near-term catalysts on bonds, and we saw everything really lining up for rally. So far we've been correct. And what we're really focused on is global growth, mostly in Europe, and nobody really ever reports on it, but you can easily get it on the terminal. That's where we get it. The European data is just awful.
Yep.
They're in a recession as we had predicted. Mild so far, but it's only going to get worse. The ECB raised rates twice during the quarter, so nothing better is happening.
Yep.
And if you look even today, the unemployment is rising in Spain and Germany. They'd have the final manufacturing PMIs 43. So that's bad. But also we had a weak PMI, which lowered our Atlanta growth rate. And then the final point is that, and we focus a lot on oil, is that it's not well discussed that gasoline prices came down 10% in a month. So it's 120% annualized. That's a little bit exaggeration, but still, that's going to show up in not just headline CPI, but more importantly, core. And this is what the Fed misses, and this is why they have all the nonsense from the 70s, because the real problem in the 70s, we had a 1,200% increase in oil prices. It bleeds through to core. So we're going to probably have cool CPI print in a couple of weeks, and PPI definitely. And so this whole narrative that we're going to like 6% bond yields should attenuate. Having said that, we think that rates will really rally when the ECB starts cutting rates in the first half or even the first quarter of next year.
So you think they're going to cut imminently? They do have a two-handle on inflation. Even maybe because they're in a recession, or maybe because inflation was transitory-ish. We were talking to Cam Harvey yesterday. You know that guy? He's a professor at Duke.
Yeah, excellent.
And he was making the point that you have been making for a while. He said, look, it's ridiculous that this Fed thinks inflation is still, 3 to 4. When you take out the rent equivalent, which is backwards looking in the wrong way to do it, we're under 2. And I immediately looked at your CPI-R on Infrastructure Capital Advisors on your website. And you guys have 1.3% right now. So explain to us how you calculate that. You use core CPI, and then you take out the rent equivalent part, and you put in Case-Shiller, right?
Correct. You can basically do it in your head.
Yeah.
So because
not my head.
You can do it in your head.
But it's kind of nutty, but the CPI still is saying shelter's 7.2%. When it's actually going up a little bit, to be fair, but it's not likely to skyrocket. But so just assume 0. Case-Shiller's been close to 0, so 40% times 7 is like 3%. So basically CPI is headline is overstated by 3%, and then it's only 33% a core. So it's overstated. Core is overstated by about 2.1%.
So, but so inflation isn't as bad as we think it is what you're saying. Still, cumulatively, it sucks, right, for consumers, especially since wages.
My New York strip is still killing me.
I don't feel like wages have kept up. Certainly mine haven't. And then growth, though, looked incredible, backward-looking, right? 4.9% in Q3. How does it look to you going forward? Because I feel like the consumer is getting hurt here, and charging everything and missing payments.
Well, no doubt. We have a saying that the average consumer is not an economist. So what we mean by that is they don't really care about CPI, whether it's R or whatever, because that's for 12 months, but they do care about 24. So prices have still skyrocketed over 24. And if your wages didn't go up, which is true for a lot of lower income consumers, and you don't own a house, you're definitely under pressure.
And by the way, CPI-R was much higher than core CPI for a while.
Correct.
Because I look back on the table, and you guys were up at 11, 12%.
Yeah, this is why we say the Fed is incompetent, because they just weren't even looking at any data. Like you can go back and say, look at PPI is actually reported. It was at 11 when they said things were transitory. So they need to redo their entire framework. And everyone should go look at the way the CPI shelter is calculated. It's ridiculous. They only updated it 1/6 every 6 months. So it's just designed to be lag. So the Fed should correct for that. In fact, the San Francisco Fed does correct for that.
But why? I just don't understand why they don't. I mean, for all the
government,
flack that Druckenmiller gives Janet Yellen, she's a super genius, right? Mm-hmm. And she's an economist, right. PhD.
Yes.
Like, she's not. Now she's like a government, political kind of a hack. But she was like a serious economist.
It's inexplicable, and I'm shocked that. Not on this program, but other media outlets, that everyone comes on and says, not the Fed, but other people, that inflation's sticky when it's just flat out not sticky. It's actually contained. It has been since July of last year.
Have we seen then peak rates?
We definitely, there's not going to be another increase. And now, for the first time, we've been saying, I think,
to the federal funds rate, right?
Yeah, we've been saying for 4 or 5 months the Fed wouldn't increase rates, but they don't know it yet. Now they know it. Now they know it after this employment report. Very cool wages, rising unemployment. So that's what they look at, even though that's a flawed leading indicator. So the Fed is clearly not going to raise. ECB is not going to raise. They're going to cut. But, all this really is going to start to impact, because we're worried about the liquidity, trillion. That's the other data we look at that most people don't. Global monetary base or supply, global liquidity really from central banks, down $1 trillion over the last 2 quarters. So it's terrible. That's probably not going to turn around until next year when the ECB is forced to cut. Because, that's a simple way to trade the market, right? It's like if the Fed intervenes during the pandemic and says we're going to increase the monetary base by a gigantic amount, you get long. If they're sucking money, it's like taking $500 off free parking, if you're playing Monopoly. Yeah. All of a sudden, if you put it on, then all of a sudden everything's overinflated and everything's go-go, you take it off and it's bad. So we're in the takeoff phase, but I think we overshot to 5%. We'll see if we keep rallying from here at 4.5%. But next year we're confident we'll get below 4%, so we'll meet our 5,000 target next year at least.
But so you don't think like the bond vigilantes will come back and say we're not going to finance this kind of deficit spending much longer?
We think there's
not at this rate.
That's a great question, because we think there's way too much focus on the U.S. budget deficit. Because, I don't know.
And Matt is concerned about it. So, are you going to try to allay his concerns?
Well, I think it's terrible from an economic growth perspective, because there's something called crowding out. So, if the government spends money, it can't be invested.
Well, if they spend $900 billion next year servicing the debt, we're not going to have enough money to spend for the next pandemic.
No, it's a horrible thing, and it's a waste of capital, and it's terrible for economic growth, terrible for everyone. But it's not enough to drive global interest rates up 100 basis points. That's my only point. At the margin, it's bad.
Yeah.
But keep in mind that our Fed, strangely, if you look at the balance sheet, is actually still monetizing part of the debt because they're unwinding their short-term borrowing. So it can't be true that that's the key driver of global interest rates. It's bad. It's a terrible economic policy. Obviously, the budget process is horrendous.
And for taxes, dude, because
Right.
now every time someone wants to cut taxes, they're going to say, we can't afford to. We got to do entitlements. We got to pay for the military. We got to pay $900 billion to service debt. So Miller and the rest of the middle class is going to have to pay half.
No, it's horrendous policy. And in fact, we're actually pretty bullish about China because they save 45% of their GDP. So savings and investment drives economic growth. That's the only thing that does it. And that's just intuitively obvious. So if the government is reducing savings, we're going to have lower growth in the long run. So it is terrible, but just not enough to drive global rates to 6, 7, 8%. That's our main point.
We learned something again today.
Mm-hmm. Yeah,
we do. Every time he comes in here. Jay Hatfield, thanks so much for joining us. Jay is the CEO and founder and portfolio manager at Infrastructure Capital Advisors. He was a banker. He was, a hedge fund dude. He's a skier up at my favorite place, Squaw Valley, which I think they've renamed it something. But still, Lake Tahoe, that whole area up there is just awesome. So if you
have they? That Squaw Valley was not cool?
No, it's something different now, so I don't know.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So Sam Bankman-Fried found guilty.
Shocker.
It took the jury like 15 minutes, a cup of coffee to convict this guy. I'm not even sure they got their pizza.
Even the trial felt like the trial was only like 2 weeks.
But there's so much evidence and so many people turned against him. It was like an open and shut case.
No chance.
But we have somebody here who's really into this business and is really read in, as the kids say. Zeke Faux, he's an investigative reporter. And he's also author of the new book on crypto entitled Number Go Up. It was released in September 2023. He writes for Bloomberg Businessweek.
And it was used in the trial.
It was used in the trial. Explain that to me, Zeke. So how was your book used in this trial here?
Hey, this was unbelievable. So, as you point out, they had so much evidence. All the top lieutenants were testifying against Sam. But then Sam decided to take the stand and tell his version of the story. Real unusual decision for a criminal defendant, because then the prosecutor gets to cross-examine you about anything you've ever said. And this prosecutor had no mercy. I felt like she was going for bonus points. I felt like she wanted to convict Sam. She's like, forget the witnesses. I'm going to convict you again right now.
Oh, boy.
And so she was like, Sam, have you ever said anything about the relationship between Alameda Research, your hedge fund, and your exchange, FTX? Have you ever said maybe that Alameda Research didn't play by the rules on FTX? And Sam was like, I don't recall. And then the prosecutor, Danielle Sassoon, was like, Your Honor, let me introduce. And then she pulled out a hard copy of Number Go Up.
Nice.
Walked it over to the witness stand. The defense was like, objection. They had a little conference. It was admitted. And then honestly, for quite some time, she had Sam read different pages of the book and was like, do you remember saying that now? And he had to just say, I don't recall. Because what's described in the book is this interview I had with him in November 2022, just before he got arrested. And he basically did not quite have his story straight. And he said a lot of stuff to me that I think he regretted. So he couldn't really admit to saying those things now. And I think it looked terrible for him in the trial in front of the jury, because when his lawyer was asking him questions, he had a lot to say. But when the prosecutor brought up his other statements, he just had to stick with, I don't recall.
That's rough. So part of me feels sorry for the guy because, I've done things wrong, and I know that feeling of regret.
Yep.
But the size of the fraud and the crimes, I would say alleged, but now I guess I can say committed, right? Since he's been proven guilty, is just massive. What do you expect, Zeke, at the sentencing? I was having a little debate over at the news desk a little bit earlier, and some of the people on the desk were like, well, Elizabeth Holmes only got 11 years, so maybe he gets 15. And then somebody else said, yeah, but Bernie Madoff got like 150 years. So, where do you think Sam Bankman-Fried falls in the pantheon of giant con men?
So, I think these sentences are determined by how much money you stole. And maybe he'll be able to try his arguments again, which is that so he took this customer money and he went and gambled it. And he wanted to say in his defense that some of those bets worked out. And the judge at his trial said, that doesn't matter. You stole this money. If you stole the money, we don't care what you did with it after. The crime is just the stealing the money. But maybe when it comes to sentencing, he'll be able to say, hey, there's not actually $8 billion missing. We've been able to find that a bankruptcy court has been able to find, $4 billion, just sentence me on the $4 billion. But even still, $4 billion is a lot. So he's looking at a bad sentence. I'd say maybe like 20 years. That's just my guess, though.
Wow. Hey, Zeke, I guess folks within the crypto space, I guess they're wondering at this point, to what extent does the whole Sam Bankman-Fried scam, the FTX debacle, how much does that negatively impact just the crypto space in general? Do you have any thoughts on that?
So I'm hearing a lot of wishful thinking from the crypto people that this does not impact them. It doesn't reflect on their project. And I think it doesn't matter if your project had nothing to do with Sam Bankman-Fried. If you start some new coin now and you go pitch it to regular people, they're going to say, oh, crypto. Isn't that how the guy with the curly hair stole everybody's money?
That's bad.
And they're not going to want to invest, So I think it is, all the publicity around this trial is horrible for crypto. And the crypto people would love to move on. But coming up next, we've got Alex Mashinsky of Celsius, who's also another crypto guy accused of a massive fraud. And if it wasn't for Sam Bankman-Fried, I mean, this one was really big too. He'd be like the big crypto villain. So maybe the bad publicity is they're not out of the woods yet. They're getting more bad publicity. Even just the other day, you got another one. Every day is another one.
Gemini and Genesis, also the Winklevi and Barry, they're in deep trouble. And I wonder though, and you've been reporting on crypto for so long, Zeke, that I feel like you know just as much about crypto as the biggest experts in it. Is it fair to lump it all into one ball? Can you put it all crypto in the same drawer? Because I've always felt that Bitcoin is one thing and all of the other coins are another.
Yeah. So I've heard this argument. I do think Bitcoin's a little different. I mean, we may have different opinions on this. I think the reason Bitcoin is different is because this whole cult has developed around it, and people treat Bitcoin almost as like a religion. And so it's going to be tougher to...
We do that with the dollar.
Change these people's minds.
That's how it goes with these things, If we all believe, then it's valuable. And if we all don't believe, then it isn't. Right?
Yeah, I mean, I would say the dollar is based on like more than belief. It's like the official currency of our country. We can use it to pay taxes. Everybody's always used it.
All right, so gold, right? Gold is probably a better, because why is this, yellow metal that we dig out of the earth valuable? I guess we use it for wedding rings and maybe like some of the foil that goes around the moon landers when NASA was doing that. But
it's a commodity, supply and demand on that.
Yeah,
one.
Bitcoin too, supply and demand.
I know.
Yeah,
I know.
I don't know. I just feel like there's all of these scams seem to happen with all of the other coins, and I just look at Bitcoin and it's worth $35,000.
Hey Zeke, thanks so much for joining us here. We got to let you go. We're up on the time, but thanks so much for joining us, Zeke Faux, investigative reporter, and he's the author of the new book on crypto entitled Number Go Up. Check it out. It was released just in September of this year. Perfect timing for our friend Zeke on all things crypto. This is Bloomberg.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
It is Friday. It is 12:23 p.m. on the Wall Street time. That means it's time for What is Matt Miller Driving? Hannah Elliott joins us as she does every time this week. Bloomberg Businessweek columnist. We're going to talk about the BMW XM, Matt's love for superchargers. Who doesn't? And Matt and Hannah's new podcast. What do you got for us?
Somebody wrote this. So listen, every week I do this segment to talk about the car I'm test driving this week. And every week I record a podcast with Hannah Elliott, who writes for Bloomberg Pursuit. So I figured, like chocolate and peanut butter, let's bring these two things together. So
what's the name of the podcast?
Our podcast is called Hot Pursuit,
Nice.
which is a play on, Hannah's unit, play on words. Hannah's unit is called Pursuits. And the podcast comes out every Saturday morning, and you can listen to it live on Bloomberg Radio, or taped to live to tape on Bloomberg Radio. But I thought it would be cool to talk about these two big trucks together. And they're very different, obviously. I'm driving a Dodge Durango Hellcat.
Saw that. Looks very cool. It's
like a family truckster, right? It's a grocery getter. And, they start at $40,000 in the base model, so very affordable. But if you put the Hellcat engine in,
oh boy,
and that's the only thing that matters to me, sure. It's a supercharged 6.2-liter V8. Then it costs $94,000, and actually you can get the price up to $110,000 pretty fast. So I absolutely love the car. I love superchargers. I love V8s.
Yeah.
But it's really all about the motor. It's not a terribly luxurious interior. The seats aren't super comfortable. I don't love the layout of the infotainment. It doesn't handle very well. I don't think the build quality is super high. It's just the supercharged motor that I care about. And I think for that, it's pretty expensive, maybe too expensive. So, but Hannah is driving like an ultra luxury truck, a BMW XM. Hannah, tell us about that.
So I've got a few points to your supercharger motor. The BMW XM does have a V8 too. This is a twin turbo V8, and it's also paired with an electric motor. This is actually a hybrid. It gets 644 horsepower, so a little bit less than that Hellcat, but sort of comparable.
Right, 710 for the Hellcat.
Yeah. So close, but I have to say the XM costs a lot more. It starts at about $160,000 starting, and it goes up from there. I should mention they're going to come out with an even more powerful edition next month. So it's fast, it's powerful, it's very expensive. Personally, I do not think it drives in the sophisticated way that we have come to expect from BMWs. It's a little bit inelegant, jerky. I found it extremely powerful, but not the greatest handling, not the greatest driving apparatus. And Matt, I think you've driven this one too, haven't you?
I have, and this is where I think...
Is this the souped up version of what I've got?
No.
I have an X.
You have an X, and this is the M version of the X. So actually, it's it's supposed to be the top of the line.
Okay,
But frankly, your car probably drives much smoother, much more sophisticated, much more elegant. And I know what Hannah's talking about because I've driven this XM before. When I first took it out of the garage in Chelsea, I noticed that the switch from electric to gas was pretty jerky. And the thing is, I think the XM and the Durango Hellcat, both of them need to be driven in anger for them to work right. And I don't know if you've been able to really wring it out, Hannah, but when I finally took the XM up to Bear Mountain and ripped it around turns at much higher speeds than are recommended, then it started to shine. I liked the anti-roll bar. I liked the suspension. But otherwise, when you're being just like a rich person driving around, there's no air suspension in that BMW. It just isn't nice.
You know, I have to say, I lived in New York for almost 20 years. I'm now in LA. I'm trying to not drive in anger. I'm trying to move past that. And I love anger. Anger is my favorite emotion. But I'm trying to really, these are my LA years, and I don't want to have to drive my BMW in anger to have fun with it. I should also say the XM is huge. It's the same size as the X7, but it only seats 6 people. The X7 is a 7-passenger. The XM, it only seats 5 people. The X7 seats 7, of course. This seats 5, so it's big. It's Matt, I think you used the word brutalist for how it looks.
It's aggressive.
I think it just looks a bit heavy-handed.
So I like that. So when you tell me this is a 7 passenger car that only seats 5, my eyes light up. Because I'm 6'4", 210 pounds.
Sure.
I like that.
Yes.
That means there's more space. It's business class. That's what this car is.
Well, there's a lot of space.
Yeah, I think that's great, and I love the big grille. A lot of people would say it's ugly on the XM. I would say it's wuchtig, which is a German word. It's powerful. Its presence can't be ignored. The Dodge Durango Hellcat, on the other hand, you can easily overlook that vehicle. In fact, it feels much smaller in a lot of ways than my Challenger, which is only a 2-door. It's definitely thinner. The seats are not big enough for my butt, So, I think it's fairly small for an SUV, even though it's a 3-row vehicle. I don't know who's going to buy that thing, but the prices haven't come down dramatically. I feel like in the long run, both the BMW XM and the Durango Hellcat, they're going to depreciate like crazy. But the XM, certainly, because, Hannah, the BMW I really want to buy, and hopefully will at the beginning of next year, is a 2020 M760. And they started at $165 MSRP. But now I'm finding them 3 years old with 30,000 miles for $65. Oh. So they've depreciated like mad, and I feel like the XM would too, except for they're not going to make very many.
No, they're not, and I have to say, even fewer of this XM label version coming, and I know I mentioned that before, but they're really kind of pushing it, I think, because they realized if this is supposed to be the most powerful BMW SUV ever made, and it is, they really need to push the power even more, because if you're getting beat by Dodge, That's not a good look, is it?
No. And by the way, that brings up another point, something that we spoke about on the podcast, and you said something where I was like, oh, now I get it. I've always wondered why Americans go to the supercharger, and I love a supercharger.
Who doesn't? Yeah, sure.
I think it's the best kind of forced induction. You get the power right at the very bottom of the rev range. And Europeans and Japanese have always gone with the turbochargers. I didn't know why, but you pointed out a pretty important reason, Hannah.
Yeah, I have a theory, and I think it's actually backed up by science, that really European roads and for instance, Japanese roads tend to be smaller, more curvy. Obviously, these are smaller spaces, while American roads are big open highways, great for driving drag races, going fast in a straight line. The turbocharger is best used on curvy, windy roads. I mean, it's amazing when you can feel the thrust of the boost kick in. That's when you really feel the value of it. You don't necessarily feel the value of a turbocharger when you're just on an open highway. Supercharger, maybe you do. That's my theory.
I think she's right.
She's on.
A turbocharger is more sophisticated.
A supercharger is?
No, a turbocharger.
Turbo.
A supercharger is just like a sledgehammer.
That sounds American.
That's why I like it. Yeah. It's pretty American. All right. The other thing that I wanted to just briefly touch on is F1. It's coming up. I know we still have another week, but tell us about, you're going to go to Las Vegas.
Yes, I will be there. I'm excited and slightly terrified at the same time. It's going to be a circus, which of course this is what we want from Las Vegas, but it's going to be wild. November 18th is the night of the Grand Prix race. Yesterday I spoke with the head of. It's a night race. It starts at 10 p.m. local time. I think it might actually be a little bit cold. But yesterday I was talking to the head of Pirelli Motorsport, who just, of course, won the contract again to provide tires until 2027. They're actually considering it to be a bit of a cold track. They're preparing the tires to be expecting a cold track. But all that to say, it's $15,000 dinners, wild parties. Of course, the Sphere, this huge event space that U2 has been performing at, it's going to be hosting some new musical guests during the Grand Prix, which is a big deal.
That's going to be good stuff. Hannah, thanks so much for joining us. Hannah Elliott, Bloomberg Businessweek columnist, joining us to talk about cars.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.